One company controls $11.5 trillion. That's almost half of America's $27 trillion GDP. It owns pieces of Apple, Microsoft, Amazon, and 90% of every major corporation you can name. During the 2008 crash, the Federal Reserve called them for help. During COVID, they did it again. This is BlackRock. And nobody elected them. So here's the question. Who actually runs America? From a $100 million loss to global domination. 1988, Larry Fink sat in his office at First Boston, staring at a number he couldn't believe. $100 million. Gone. A single bad bet on mortgage securities had just vaporized 9 figures. First Boston was one of Wall Street's elite investment banks. They didn't tolerate losses like that. Fink was out. Most people would have taken a corporate job somewhere quiet after that kind of failure. Fink went the opposite direction. He realized something crucial. He hadn't lost that money because markets were random. He'd lost it because he couldn't see the risk coming. So he started BlackRock with 7 partners and $5 million. The mission was simple: build technology that sees risk before it kills you. That was 37 years ago. Today, BlackRock manages $11.5 trillion. That's bigger than Japan's entire economy. It's more than India, the UK, and France combined. It breaks down to roughly $33,000 for every American citizen. But the money isn't what makes BlackRock powerful. It's what comes with the money. BlackRock owns 5 to 10% of almost every Fortune 500 company. That means board votes, influence over executive decisions, the ability to move entire industries with a single investment thesis. A fired trader turned one catastrophic loss into the most influential financial institution on the planet. Here's how. Aladdin, the machine that sees everything. BlackRock's secret isn't just smart investing. It's a system called Aladdin. Aladdin stands for Asset Liability Debt and Derivative Investment Network. It's an AI-powered risk management platform that analyzes $21 trillion in global assets. That's not just BlackRock's money. Over 200 financial institutions, pension funds, insurance companies, and sovereign wealth funds run their portfolios through Aladdin. Every day, this system processes 200 million calculations. It models what happens if interest rates spike, if currencies collapse, if wars break out, if pandemics spread. Aladdin doesn't just predict risk, it shapes how the world responds to it. 2008 proved this. Lehman Brothers collapsed. Bear Stearns was gone. Nobody knew which banks would survive the night. Mortgage-backed securities were toxic, but nobody could figure out what they were actually worth. The Federal Reserve was in crisis mode. They needed someone who could value assets the entire banking system couldn't price. They called BlackRock, gave them access to the government's books. BlackRock's Aladdin system analyzed the wreckage and told the Fed which institutions to save and which to let die. A private company made decisions that reshaped the American economy. No hearings, no oversight, just emergency contracts signed in back rooms. 12 years later, it happened again. March 2020. COVID lockdowns triggered a market collapse. The Federal Reserve needed to stabilize corporate debt markets, something they'd never attempted in their history. But they didn't manage the program themselves. They outsourced it to BlackRock. BlackRock selected which companies got liquidity, which industries received support, which bonds the Fed would buy. Think about what that means. The world's most powerful central bank handed emergency response to a private firm, twice in 12 years. And both times, BlackRock got paid. Both times, their influence expanded. The government's power problem. Let's be clear about what the government can do. Congress writes laws. They can raise taxes, regulate industries, break up monopolies. That's legislative power. The military controls the most advanced weaponry in human history. Aircraft carriers, drone fleets, nuclear arsenals. Hard power no corporation can match. The Federal Reserve sets interest rates, controls the money supply, can inject trillions into the economy overnight. Agencies like the SEC, FTC, and Justice Department regulate Wall Street, enforce antitrust laws, and prosecute financial crimes. On paper, government power is absolute. In practice, there's a problem. The U.S. government owes $36 trillion. Every year, they run deficits in the trillions. To cover that gap, the Treasury issues bonds. Who buys those bonds? Institutional investors. BlackRock, Vanguard, State Street. The same firms the government is supposed to regulate. So the government borrows from the institutions it oversees. That creates leverage. And leverage flows both ways. The executive pipeline. Wall Street and Washington aren't separate anymore. They're connected by what insiders call the revolving door. Senior government officials leave for high-paying corporate jobs. Corporate executives get appointed to shape government policy. For BlackRock, this isn't occasional. It's structural. Brian Deese ran BlackRock's Sustainable Investing Division, then became Biden's director of the National Economic Council, setting the administration's entire economic agenda. Adewale Adeyemo went from BlackRock executive to Deputy Treasury Secretary, the second most powerful position in America's financial system. Michael Pyle left BlackRock's investment strategy team to become Kamala Harris's chief economic advisor. These aren't mid-level staffers. These are people shaping trillion-dollar policies, and they came directly from a firm that manages $11.5 trillion. When they were at BlackRock, they managed assets. In government, they regulate assets. Same markets, same money, different desks. The question isn't whether this creates conflicts of interest. The question is whether anyone cares. Lobbying, regulation, and the system that protects itself. After 2008, Congress passed Dodd-Frank, sweeping financial regulations designed to prevent another meltdown. Banks faced stricter capital requirements, stress tests, federal oversight. Asset managers like BlackRock, they walked away almost untouched. Why? Because they don't technically take deposits. They don't make traditional loans. So they operate outside most banking regulations, even though they wield more influence than most banks. Between 2020 and 2024, BlackRock spent millions lobbying Congress. Not to break laws, just to make sure new laws don't hurt their business model. That's not corruption. That's just how the system works. Companies protect their interests. Politicians need campaign donations. Everyone stays friendly. The result? BlackRock gets the economic power of a bank without the regulatory burden. How your retirement gave BlackRock control. BlackRock paid $13.5 billion to acquire Barclays Global Investors. The prize wasn't the company itself. It was iShares, the world's largest ETF provider. ETFs, exchange-traded funds, revolutionized investing. Instead of picking individual stocks, investors buy a single fund that holds hundreds or thousands of companies. It's simple, it's cheap, it's passive, and it concentrates power. When you invest in an S&P 500 ETF, you own tiny pieces of 500 companies, but you don't vote those shares. BlackRock does. And because millions of investors use the same index funds, BlackRock becomes the largest shareholder in almost every major company. Today, iShares manages over $3 trillion. BlackRock controls 35% of the entire U.S. ETF market. Every time someone contributes to their 401k, every time a pension fund rebalances, money flows into these index funds. And BlackRock's voting power grows. You gave them your proxy without realizing it. And now they vote in thousands of boardrooms on your behalf. Owning both sides of every competition, BlackRock is the top shareholder in Coca-Cola, also the top shareholder in Pepsi. Same with McDonald's and Burger King, Delta, United, and American Airlines, ExxonMobil, Chevron, and Shell. When one investor owns competing companies, economists call it universal ownership. And it changes how markets work. If you own both Coca-Cola and Pepsi, do you want them destroying each other in a price war? No. You want stable prices and steady profits. Competition hurts your portfolio. Academic research backs this up. Airlines with common ownership charge higher ticket prices. Banks with shared investors pay lower interest rates on deposits. When major shareholders overlap, competition softens. It's not a conspiracy. It's just incentives. BlackRock makes money either way, so why push companies to compete aggressively? The result is higher prices, lower wages, and record corporate profits. Shareholders win, everyone else loses. And it's completely legal. Infrastructure, housing, and the real asset shift. BlackRock is moving money out of traditional securities. They're buying physical infrastructure. They launched a $12.5 billion fund targeting toll roads, airports, energy grids, and water systems. Assets that generate revenue regardless of stock market performance. They're buying farmland, telecommunications networks, data centers that power the internet. They're also financing private credit, lending directly to corporations outside the banking system. No Federal Reserve supervision, no bank capital requirements, just institutional money flowing through shadow banking channels. And real estate. BlackRock-backed funds are purchasing single-family homes at scale, converting ownership into permanent rentals. In competitive housing markets, institutional investors now own 20 to 30% of entry-level properties. First-time homebuyers can't compete with all-cash offers 15% above asking price. No inspections, no contingencies, just algorithms buying houses faster than families can. Home ownership is becoming a luxury. BlackRock is positioning itself to collect the rent. ESG, power disguised as principal. For years, Larry Fink published annual letters telling CEOs to prioritize climate change, diversity, and social responsibility. accountability. SG, environmental, social, and governance investing. Companies listened because BlackRock controlled their stock price. Then Republican states pushed back. Texas, Florida, and others pulled billions, accusing BlackRock of weaponizing capital for political goals. BlackRock rebranded. SG became transition investing. Same strategy, softer language. But here's the real power move. BlackRock holds trillions in proxy votes. That means they can pressure corporations without passing a single law. If a CEO resists their agenda, BlackRock votes against board members. If a company ignores their recommendations, BlackRock withholds support. It's corporate governance without democratic accountability, influence without legislation. And when climate regulations do pass, BlackRock already owns the companies that benefit. They're positioned to profit either way. Redefining power. Power used to be simple. Armies, laws, borders, force. But economic leverage works differently. BlackRock can't arrest anyone, can't declare war, can't pass legislation. But if they pull capital from an industry, that industry collapses. If they dump a stock, that stock craters. If they decide a company needs new leadership, that CEO is gone within months. Russia invaded Ukraine. Governments imposed sanctions. But simultaneously, BlackRock and other asset managers pulled out of Russian investments. Was that government pressure or strategic positioning? Both. And that's the point. The line between corporate strategy and government policy is blurring. Here's another angle. If voters don't like the president, they can replace him in 4 years. But Larry Fink has run BlackRock since 1988, 37 years. No elections, no term limits, just consistent compounding influence. Who has more long-term power? The elected official who might lose their job? Or the CEO who's been there for 4 decades? The accountability gap. So who runs America? The government or BlackRock? Wrong question. They run it together. Intertwined systems where political power and economic power reinforce each other. The government has legal authority. BlackRock has financial leverage. And increasingly, you can't tell where one ends and the other begins. But there's a problem. Democratic accountability. If the government screws up, voters can fire them. If BlackRock makes a bad call, who holds them accountable? Their clients are pension funds, insurance companies, and sovereign wealth funds, institutions managing money for other institutions. There's no ballot box for asset managers. This is the new reality. Power isn't just in Washington anymore. It's distributed across boardrooms, trading algorithms, and financial networks most people never see. The man who lost $100 million in 1988 now controls $11.5 trillion, and he doesn't answer to voters. So here's my question for you. Should one company hold this much power without democratic oversight? Or is this just how modern capitalism works? Let me know in the comments. And if this changed how you see the system, hit like and subscribe. See you in the next one.